Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking precious metals as we are chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. So, Jordan, one theme that we've talked a lot with you about over the last couple of months is what gold usually does on the back and around a Fed rate hike, and even more importantly, a rate hiking cycle. Now, you've been on record saying that gold has actually done quite well when the Fed has started hiking rates, which does, I think, provide some encouragement for the gold investors. We are nearing sometime next year the Fed starting to hike rates as long as everything keeps playing out the way that, well, they've outlined now. But there's one thing we haven't talked about, and that's what gold does before the rate hikes start. You've done some research on this. Can you share how you have seen throughout history gold react now, so even before the rate hikes start, please?
Yes. So looking at the research, we know that gold and silver as well, they both typically sell off before the rate hike. And I've been keen on that in the last couple months. And more recently, gold's been holding up fairly well. It's in the low 1800s now. It had that peak 1869 or 1870, something in that area. And so typically, there can be like a 13 or 15 or 12% type of sell off. And, gold it's holding up pretty well. And we're getting closer to the rate hikes. I mean, you can't listen to people like Peter Schiff who are saying there's not going to be a rate hike. It doesn't make any sense. You have to, well, don't listen to me, just follow the market. And the market right now, if you look at Fed funds futures in March, the market is showing right now a 60% chance of a hike in March. That's only 3 months away. And in May, the market is showing about a 74% and change percent chance of a rate hike. So, and by the way, if we look at the stock market, I mean, both the Dow has made it's going to close at a new all-time high today. The S&P is a new all-time high. I don't see anything that's going to happen to derail the fact that we're looking at a rate hike in March or May. So there's still some time for gold and silver to sell off before that hike. And, the important thing is, and I looked at this for my premium update last weekend, and if I'm looking at the 2 months before they do the first hike, I looked at gold, and the last 3 hiking cycles, the 2 months before the first hike, the gold was down about 11% to 13% every time. So that is not good news considering what looks to be coming in March or May. And so, we're looking at these percentages, they're rising. And if we see the metals start to crack and trend lower and we get a big sell-off, that's just a sign that the hike is coming. I mean, it's not imminent, but it's getting pretty close, and that the metals are likely to, bottom around the time the Fed executes that first hike. So that's what I'm thinking about right now, even though, gold has held up relatively well. Above 1800, 1750 on the weekly chart is still pretty significant support. So if we see, a day or two of some heavy selling in gold bringing us closer to that 1750 support, I guess what I'm saying is it's not going to take a lot to push this market to a breakdown. And, that aligns with history and what happens in the, 2 months before the Fed executes the first hike. So that's something I think we all need to think about here. It doesn't mean we need to completely panic about everything, but just understand and realize that there is a real threat of a sell-off here. And the good news is that sell-off leads to an even bigger rebound after the Fed executes the hike, based on the history.
Well, Jordan, in that kind of environment where a couple of months before the rate hike, if there is that sell down, where do you see support coming in? Do you think that 1675 level that was tested 3 times would hold? Could there be a break below that? And on the other side, if gold was to continue to truck higher and avoid that to some degree, where do you see overhead resistance coming in right now?
Well, let's start with resistance. I see resistance at 1830, 1835. I would be really surprised if gold was able to surpass that here in the short term. I mean, obviously, if it traded above that level, then you have resistance. I don't have the chart in front of me, but I want to say around 1850, 1860. So those would be the levels. But again, we would, going back to what's happened earlier this year, we would need to see a weekly close and a monthly close. I mean, if gold starts off the year pretty strong, it could even surpass 1835. My guess would be, yeah, that's nice, but it's not going to close January, at 1850 or 1860. I don't see that happening. Now, on the downside, obviously, we have 1675. But, in this scenario, I would not be surprised, the scenario of gold selling off right before the first rate hike. I would not be surprised if you get a break below 1675, but it turns into some kind of a false breakdown. And we know in gold, there's a lot of false moves in both directions. I mean, we've had a couple of false breakouts in recent months or in the last 12 months. So it would not be a surprise to see gold break below 1675. Everybody's panicking, but sentiment starts to turn really bearish. And, the rate hike gets done, and then you have what you need for, a real solid V rebound in gold. I'd also look at the 40-month moving average, and, that's going to come in around 1630 right now as we close December. It's moving up, I want to say about $10 every 3 weeks. So, if we see the first hike in March, then, potentially the 40-month moving average could be, if you add another middle of February, maybe that comes in at 1650 or so. So the 40-month moving average, if gold were to break down in the next 1 to 3 months, that's going to be coming into the mid 1600s, not that far below that 1675 support. So that's a logical target. And look at a monthly chart going back 30 years. The 40-month moving average is not just some random target that we're picking out of thin air. Look at the last 30 years in gold. It's been a critical level for gold. It's marked, numerous peaks and lows over the years. I think there was a low in, I want to say 2019, right before gold took off. It rallied off the 40-month. I think it supported the financial crisis low in 2008. So this is a very important level. And again, it's in the next couple months, it's going to be coming in not too far below 1675. So for all these reasons, it would not worry me if gold breaks below that support. I mean, depending on where sentiment is and how close we are to the hike, breaking below 1675 could actually be a buy signal rather than a sell signal.
Interesting, Jordan. I do want you to take kind of a broad look here at a weekly chart. I have this weekly chart open. It goes back to about mid-2019. And I've heard the argument on both sides. One argument saying that the gold price has consistently put in higher lows, dating the whole way back to 2019. I've also heard the argument that the gold price has been putting in lower highs going back to that high from August of 2020. Now, I realize this really makes a mess of the chart, and quite frankly, you look at 2021 and all gold did was bounce a little over 1800 and a little under 1800. What do you take away, and what do you think is most important? Is it those higher lows? Is it those lower highs? Is it anything else on this weekly chart?
Well, I mean, what I would take away is looking at it. I mean, it's clear that gold, it's in a correction. So when there's a correction, I'm not really concerned about higher highs or higher lows. I mean, I guess you could say it has put in lower highs and higher lows, but that happens during a correction. We see that often. So it's missing the larger picture. So where we have to step back and we see that there's this clear handle building on a cup and handle pattern. And the handle is still fairly bullish as long as gold holds above 1570 or so. That's a 50% retracement. When a cup and handle corrects more than 50%, it's really not a bullish cup and handle anymore. I mean, it still could be viable, but just for being a bullish cup and handle pattern, it really needs to hold above the 50% retracement. And so I don't think that's looking at what we've talked about before. And even if gold breaks below 1675, I don't see that being threatened. So I see gold building a handle, building a super bullish consolidation. So, I mean, trying to argue about higher highs and higher lows, I don't think that's really significant. I mean, gold, if looking at the weekly chart, 1750 is the key level because gold has not closed below that, I think, since April. And there's been numerous times where 1750 on the weekly has been support. I mean, I'm looking at, it was once in June, we had that bear trap or whatever in August where it came down below 1700. it held above 1750 on the weekly. And then in September, a couple times, it got real close to breaking it. And then 3 weeks ago, it bounced above 1750. So that to me, we're not going to see much change until gold breaks below 1750 on the weekly. However, if it doesn't do that, it's probably just going to, over the next several months, it'll probably remain between 1750 and 1850 possibly. That would be the bullish outcome here before the hike, where gold just doesn't really do much. It trades in a range. Volatility continues to compress. The Fed executes the hike, and then a little bit after that, we could see gold pop above 1850. And at that point, it would be clear that it has made some kind of significant breakout. But that being said, if you look at the monthly, we really need to break above 1900 on the monthly to have a significant breakout. So that goes back to everything we've looked at over the last year. So I don't mean to dance around the question. I just think if we're arguing over lower highs and higher, it's just not really significant in the larger setup for gold, which is it's building a handle consolidation on a super bullish cup and handle pattern. And even if gold breaks lower, that's not going to, in my opinion, it's not going to derail the bullishness of the overall larger pattern. I mean, this handle, we're not even we had a 10-year cup and the handle is 17 months. And, it'd be perfectly normal if it took another 6, 9, 12, even 18 months for gold to break much higher. And even if it did take another 18 months, it's just giving the market more fuel for that super bullish explosive breakout, above 2100.
Well, Jordan, I'm hoping it's more like 6 months instead of 18 months on that handle, but I understand the point you're making. It still would be a larger pattern that takes time to play out. And when it does play out, the larger pattern is what's primary for the trend. But as far as the mining stocks, which a lot of our listeners are invested in, and so are all of us on this call, we see this kind of pattern every year where there's some tax loss selling. And then sometimes we get that pop into January where people get repositioned to start the year. It's generally the strongest month. January is for gold and the gold miners. The miners, though, are priced like they're already at that 50% retracement at 1570. They're priced where they were, GDX and GDXJ, where they were when gold was in the 1500s to 1600s. So do you think that means the miners are indicating these lower prices you're talking about in gold, or are they just undervalued relative to the metals, and could they pop a little bit more from where they're at?
Well, it's interesting to me because, you do have the setup of a potential double bottom, although I don't think I would bet that it's probably going to be broken to the downside. I mean, looking at GDXJ, for example, 37.5 is pretty good support, but you could see that level break. There's really strong support around 34 and 35. So if my outlook on gold is correct, as far as, we get this big sell-off a month to 2 months before the first hike, I don't see the miners diverging from that. But, maybe they hold up maybe they drop, but they hold up fairly well against gold. Maybe a select group of miners and juniors, they just go sideways and they don't really sell off because they're already so oversold and they have bullish fundamentals. And that's something to keep an eye on. So I think I'm going to look at individual stocks and see how they perform going into the hike, assuming that, the gold selling off, silver selling off. I think that's the time to really look for divergences with individual stocks and see how they're performing and acting. Like, is the selling all done in those stocks? Are some really getting oversold? In some names you could have where the chart makes it's like a fishing line. Okay, rhino horn is when it's bullish. You could get real fishing lines in some stocks that could be a buying opportunity. So I guess I'm thinking, I'm more thinking about how certain individual stocks are going to perform in that environment more so than the overall sector. But that would just be my view, as I would lean towards my bias being to the downside. And again, looking at GDXJ, there's strong support at 37.5, but also 34 and 35. If you just look at the last 10 or 11 years, that's been an important level. And also the 62% retracement from the 2016 low to the 2020 peak is right at 34, I think. So that's a level that I'm keeping in mind. But yeah, I just, looking here at the short term, maybe we get some more of a push higher at the beginning of January, but I just don't see this being the start of a big rally. I just think it's more likely to come after the hike.
So, Jordan, the big picture, I guess, narrative around the gold stocks this year, especially, has been the disconnect between the stocks and the underlying gold price, where the stocks truly have underperformed where gold is. Because we were chatting with Jeffrey Christian last week. He mentioned that gold, for an average price throughout this year, is the highest it has ever been. But the stocks, they're nowhere close to their highs that they were just a year ago, let alone a decade ago for some of these stocks. Do you see this continuing to be a trend next year where stocks broadly underperform the underlying gold price, or is something going to change here?
Okay, great question. And I just did a video on this. So the reason why they've underperformed in the last year, I mean, it's master of the obvious here. And the same thing happened after 2016. I mean, remember gold, we had this great move. And then 2017, for most of 2018, gold actually held up fairly well. It's rising costs. Its margins are getting compressed because at present, over the last 18 months, and also after 2016, yeah, the gold price held up well in both instances, but you had rising costs in both scenarios. As the gold price held up and consolidated, costs were still rising, and costs have been rising materially in the last 18 months. And the gold price is trading at 1,800 when it peaked at 2070. So that's really the reason. And I don't foresee the stocks as a whole. I don't think they're going to outperform gold. The two times they really outperform are when you're coming out of a significant low or when there's a major breakout in the gold price. So to me, I would think that we could see them outperform out of the first rate hike. Typically you have like a 4 to 7 month rebound after that first hike. And so that could be a period where the stocks as a whole outperform, with most of that outperformance you probably see in the first 2 months, like immediately after the hike. And beyond that, I would expect real outperformance when gold eventually takes out 2,100. I mean, when we see gold go from 1,900 to breaking 21, and then it gets up to 23, 24, 25, that is going to be the next time when you really see like strong, big time outperformance from the stocks over gold. So I know there's a lot of nuance to that answer, but that's how I see it. So moving forward, I do think based on that, I do think there is, based on the rate hike and the immediate aftermath of that, there is a chance where we could see the stocks as a whole really outperform. But this is why generally it's better to focus your efforts on being a stock picker and picking the best companies that can outperform. Build your own GDXJ, because that's going to perform better over several years than if you just hold GDXJ.
Absolutely. That I agree with. And hey, look, quite frankly, it's been a tough year again, but there have been some very good winners. So if you can isolate those good stocks and hopefully not get sucked in at least too long into some of these other stocks that are lagging, then you still can do well in this environment. But I know, and I think all precious metals investors would really just like to see a leg higher in the precious metals that lifts all the stocks higher. But doesn't necessarily sound like that is at least on the horizon in the near term. But again, who knows? Everything can change as we move into the next year. Jordan, great chatting with you, man. Always a pleasure chatting with you throughout this year. I look forward to chatting with you all throughout next year and keeping up to date on what the charts are showing you for the precious metals. So again, remember, Jordan writes The Daily Gold, which we will link to below. Jordan, thank you very much for your time today. Hope you have a very happy new year.